The market does not pay you to be right. It pays you to be right at the right time. You can correctly determine the direction of a stock. You can analyze its fundamentals to perfection. You can possess the conviction of a zealot. But if your timing is wrong, you will lose your money. The stock you bought will go down 10% before it goes up 100, and your broker will sell you out. The stock you shorted will have one last violent rally, and your capital will be consumed. The greatest cause of financial ruin on Wall Street is not being wrong about the market's direction, but being right too soon. The speculator's chief business is not to forecast, but to identify the exact moment the market itself confirms his opinion. All my years of study, all my millions made and lost, were dedicated to solving this one problem of timing. The solution I found, the key to it all, is what I call the pivot point. Do not confuse this with some simple mathematical calculation spat out by a machine. The pivot point is not a number, it is a moment. It is a critical juncture in the price of a stock, a psychological barrier that once crossed signals that the line of least resistance has definitively changed. It is the precise point where you stop watching and start acting. To act before this point is to gamble on hope. To act after this point is to trade on confirmed fact. My entire method of speculation was built upon waiting patiently for these points to appear, and then acting upon them with courage and decisiveness. In my youth, I did not understand this. I was a boy wonder in the bucket shops, the unregulated brokerages of the day that were little more than gambling parlors which bet against their own clients. I could read the tape, the stream of prices that was the ancestor of your modern stock chart, better than any man alive. I knew the immediate fluctuations, the small 3- and 5-point moves. But when I came to New York with my first real stake, I lost it all. I lost it because I was trying to trade the big swings with the same rapid-fire tactics I used for the small wiggles. I would see a stock was cheap, and I would buy it, only to watch it get cheaper. I would see a stock was high, and I would short it, only to watch it scream higher. My analysis was often correct in the long run, but the market's tuition for my impatience was severe. I learned through the repeated and painful process of having my capital wiped away that my opinion was worthless until the market's own action validated it. Jesse Livermore consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk $1 of your own capital. To ensure this timeless wisdom translates accurately to the modern computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. The pivot point is the market's validation. It is the signal that transforms speculation from a game of chance into a business of probabilities. There are 3 primary types of these critical points, each serving a different purpose in the life cycle of a trend. You must learn to identify them as a sea captain learns to read the sky. They are your warning of storms and your promise of fair winds. The first and most powerful is the base breakout pivot. This is the pivot that gives birth to a new major uptrend. It appears after a stock has been dormant, trading sideways in a narrow price range for an extended period, weeks, months, sometimes even longer. This sideways channel is known as a base of accumulation. While the public sees a boring dead stock, the astute speculator sees a giant spring coiling for a massive release of energy. During this time, the smart money, the insiders, the composite operator, is quietly absorbing shares from impatient and discouraged sellers. You can see this on the tape. The price will fluctuate within its narrow channel, but the volume, the number of shares traded, will begin to shrink, especially on days the price drifts toward the bottom of the range. This drying up of volume is a critical sign. It tells you that the supply of stock available for sale is being exhausted. The weak hands have all sold. The pivot point is the absolute top of this accumulation range. It is the ceiling that has held the stock down for months. Your job is not to buy the stock while it is in this base. To do so is to tie up your capital in dead money, waiting and hoping. That is a loser's game. Your job is to wait. You watch that ceiling, that line of resistance, and you do nothing until the stock is ready to move. The signal comes when the price approaches that pivot point and then pushes through it decisively. And it must, without exception, be accompanied by a dramatic increase in volume. A breakout on low volume is a lie, a trap set for the unwary. But a breakout on a surge of volume that is many times the daily average is the truth. It is the sound of the starting gun. It signifies that the quiet accumulation is over, and the public-facing phase of the markup has begun. That precise point of penetration is the base breakout pivot. It is here, and only here, that you should make your first commitment to the stock. You buy a probing position the moment it crosses that line. The line of least resistance is now upward. The path is clear. The second type of pivot is the continuation pivot. A healthy trend does not move in a straight, uninterrupted line. It moves in waves, advancing and then resting. The continuation pivot is the signal that a period of rest is over and the primary trend is resuming. After a stock has made a powerful move up from its initial base breakout, it will inevitably pause to consolidate its gains. This is what is called a normal reaction. The stock might pull back from its highs, or it might move sideways in a smaller, tighter range. Amateurs see this pause and grow fearful. They snatch their small profits, afraid the run is over. The professional sees it as a sign of health. He watches the character of this consolidation. If the pullback occurs on dwindling volume, it is bullish. It shows that there is no aggressive selling pressure, merely some light profit-taking. The stock is being passed from weaker hands to stronger hands who are willing to buy on the dip. The continuation pivot is the high point of this consolidation period. As the stock rests, it will form a new, smaller ceiling. When the price breaks through that new, higher ceiling on another burst of volume, it is the continuation pivot. This is the market's signal that the rest is over, and the next leg of the advance is beginning. This pivot is of paramount importance for building a large position, what I called pyramiding. My rule was to never add to a losing position. That is the single greatest sin of speculation. Instead, I added only to my winners. My initial probe was at the base breakout. If that trade showed a profit, I would wait for the first normal reaction and the subsequent continuation pivot. At that point, I would add to my line. If the stock continued higher and then formed another consolidation, I would add again at the next continuation pivot. Each new purchase was made at a higher price than the last. This may seem backward to the man who is always hunting for bargains, but it is the essence of sound speculation. You are not buying more of a stock. You are buying more proof that your original judgment was correct. The continuation pivot is the market giving you that proof, and it is an invitation to press your advantage. The third and most subtle type of pivot is the reversal pivot. This is the point where a long-established trend finally exhausts itself and changes direction. It is the signal of a major top or a major bottom. Trading these pivots requires the most experience and the coolest nerve, because you are acting against the prevailing sentiment of the entire world. When a great bull market is in its final, frantic stages, the public is euphoric. Every shoeshine boy is giving stock tips. The news is wonderful, but the tape begins to tell a different story. The leading stocks, the ones that have led the entire advance, suddenly stop making new highs. They begin to churn, trading huge volumes of shares but making no upward progress. This is the hallmark of distribution. The smart money that accumulated these stocks at the bottom is now quietly feeding their shares to the ravenous public at the top. The reversal pivot at a market top is often a specific event. A stock might surge to a new all-time high in the morning on tremendous excitement, only to reverse and close at the low of the day on even heavier volume. This is a key reversal, or one-day reversal. It is a violent and definitive sign that the buying power has been exhausted and the sellers have taken control. The pivot point is the low of that reversal day. If the stock breaks below that level in the following days, it is a confirmed signal that the trend has turned. This is where I would sell all my long positions. This is where I would begin to probe the short side, selling borrowed stock in the expectation of buying it back at a much lower price. The line of least resistance has now shifted from up to down. You do not argue with it. You do not hope it is temporary. You obey the signal and align yourself with the new trend. Conversely, the reversal pivot at a market bottom occurs amidst utter panic and despair. After a long and painful bear market, the news is terrible. Companies are going bankrupt. The public has sworn off stocks forever. The final stage is capitulation, where the last holders throw their shares away at any price just to make the pain stop. This creates a selling climax, a day or a week of astronomical volume where the stock price collapses in a final washout. After this climax, the selling pressure is exhausted. The stock stops going down. It may drift sideways on very light volume, refusing to fall even when more bad news is released. This is the first sign that a bottom is forming. The reversal pivot occurs when the stock finally manages to rally and breaks above the highs of this small bottoming consolidation. It proves that demand has finally overcome supply. This is your signal to begin buying. You do not try to catch the absolute low. That is a game for liars and fools. You wait for the selling to end and for the trend to prove it has turned. The reversal pivot is that proof. In every case, the pivot point is useless without its two essential companions, volume and the time element. Volume is the energy that validates the price move. A breakout that is not confirmed by a powerful surge in volume is a false move designed to trap the impatient. It shows a lack of institutional conviction. I would not trust such a move with a single dollar. The time element is just as critical. When a stock breaks through a genuine pivot point, it should not hesitate. It has just overcome a major barrier, and the path ahead should be clear. It should accelerate. If instead it breaks out and then falls back, or simply sits there and does nothing for days, I become suspicious. I take it as a danger signal. The move lacks the vitality it should have. In such cases, I will often sell my position at once, even at a small loss. My capital is too precious to be tied up in a situation that is not acting right. The market has told me something is wrong, and I listen. To succeed, you must burn these patterns into your mind. Study the charts of the great winning stocks of the past. You will see these pivots appearing again and again. You will see the long, quiet base of accumulation. You will see the explosive base breakout on huge volume. You will see the series of orderly consolidations and the subsequent continuation pivots as the stock marches higher. And you will see the churning distribution at the top, followed by the decisive reversal pivot that signals the end of the run. This is the language of the tape. It is a language of facts, not of opinions or hopes. The pivot point is the market speaking to you directly, telling you when to be patient and when to be bold. It is your job to listen and to act without hesitation when the moment comes. The money is not made in the thinking. It is made in the sitting, in the waiting for these perfect, unmistakable moments of opportunity. Master the discipline of waiting for the pivot point, and you will have mastered the art of speculation.